Welcome to this explainer. Okay, today we're diving into something that affects almost every single one of us at some point, but honestly, it's rarely fully understood. We're talking about the hidden price of borrowing. I was absolutely fascinated to learn how loan interest can so quietly and so easily trap people. So, we're going to figure out together exactly why this happens, and more importantly, how to navigate it. Let's jump right in. I want you to picture a scenario. Let's say you hit a bit of a snag. Maybe it's a surprise car repair or an unexpected medical bill, and you need to borrow $5,000 to fix this temporary problem. You tell yourself, hey, no big deal, I'll pay it back in a few months. It seems incredibly straightforward, right? You get set up with a small, manageable monthly payment, and it feels like there is absolutely nothing to worry about. But as we so often see, those months casually turn into years, and those years turn into a whole lot more payments.
Then, one day, you check your loan statement, and you're hit with this wait a minute realization. You have already paid back more than the original $5,000 you borrowed, and yet, you still owe money. How on earth is that even possible? Is the bank pulling a fast one on you? Or is there this fundamental mechanic of interest that most of us just aren't taught? Well, stick with me because we're going to uncover exactly what's happening behind the scenes.
Section 1, the monthly payment illusion. Meet Alex and Maya.
So Alex and Maya are both 27. They both just landed great new jobs. But their outlooks on money, totally night and day. Take Alex. His whole mindset is basically rooted in instant gratification. His philosophy is, if I want something, I'll just borrow the money. Now Maya, on the other hand, she's all about long-term financial prudence. Her rule is, I only borrow when I truly need to. And it's these two completely different mentalities that really set the stage for everything that comes next. Let's see how Alex's philosophy actually plays out in the real world. One afternoon, he decides he really wants a new motorcycle, so he takes out a loan to get it. When he's looking over the paperwork, he fixates entirely on one number, $180 a month. He smiles and thinks to himself, oh yeah, that's easy. To him, that monthly payment looks totally affordable. But when Maya asks him if he checked how much he's going to pay in total over the entire life of the loan, Alex kind of just shrugs. He only looked at the monthly payment. He is completely ignoring the total cost. And honestly, this brilliantly illustrates a massive trap. Think of it like buying a movie ticket. Say you buy a ticket for 15 bucks. It's simple, right? You pay once, the movie is yours to watch, done. But now, imagine instead you agree to pay just $2 every single month for that exact same ticket. $2 feels like nothing right now, but eventually, month after month, year after year, you are going to pay way, way more than $15. Loans work exactly the same way. That monthly payment feels small and totally manageable, but what actually impacts your wealth is the total cost over time. Section 2, the cost of borrowing time. Understanding what you really pay for. The really crucial point here is summed up perfectly by Maya. She says when you borrow money, you're also borrowing time. Think about it. The lender is handing you money today, and in return, you have to gradually pay it back. Interest isn't just some random, arbitrary fee the bank makes up. It is literally the price tag of getting that money earlier instead of waiting until you've saved it up yourself. Time has a literal price. And the longer you take to repay that loan, the more of that price, the more interest you are going to end up paying. To really visualize how this affects your monthly payments, imagine you're carrying a bucket of water home. But there's a catch. The bucket has a tiny hole in the bottom. Every few steps you take, some water leaks out. You keep pouring more water in, but a good chunk of it just keeps disappearing before it does you any actual good. High interest debt is exactly like this leaking bucket. You make your payments every single month, like clockwork, yet a portion of each payment goes entirely toward interest before it even touches the actual amount you borrowed. That's exactly why, at the beginning of a lot of loans, your balance barely even seems to move. It makes the debt feel incredibly difficult to escape. Section 3, the high-interest debt trap, the credit card surprise. So a few months after getting the motorcycle, Alex gets himself a credit card. And he goes a bit wild, buys a new television, a new phone, some furniture. But when that massive bill finally arrives, he makes a highly dangerous choice. He decides to only pay the minimum amount. I'll just pay the rest later, he figures. Now, a minimum payment is just a tiny payment that keeps your account active. Sure, it keeps you out of default, but it is specifically designed to keep that debt around for much, much longer. It gives you this completely false sense of security. Months pass for Alex, and the interest just silently keeps accumulating on his unpaid balance. Because remember, small payments absolutely do not mean small costs.
To put it another way, Alex is basically dealing with a snowball rolling uphill. Imagine trying to push a massive, heavy snowball up a steep hill. Every single step requires just immense effort. But worse than that, before you even reach the top, new snow keeps sticking to it, making it heavier and heavier as you go. That is exactly what high-interest debt feels like when you're only paying the minimums. You feel like you're putting in all this exhausting effort to push forward, but new interest just keeps packing onto the debt. The solution isn't just pushing harder. You actually have to stop the new snow from accumulating in the first place. Section 4. Good debt versus bad debt. Are all loans bad?
Now, you might be wondering, is borrowing just universally a bad idea? Maya points out that no, not all debt is evil. There's actually what we call good debt. We're talking about borrowing for tools that literally help you earn a living, or financing an education that directly increases your earning potential, or, say, getting a mortgage on a reasonably priced home that you can actually afford. These are things that provide genuine long-term value. Bad debt, on the flip side, is exactly what Alex was doing, borrowing for expensive gadgets, luxury shopping sprees, or vacations that lose their financial value the very second you swipe the card. The debt sticks around long after the excitement of the purchase vanishes. The real difference here is what that borrowed money is actually helping you accomplish.
Section 5. Your financial escape plan. Flipping the script. Fortunately, Alex finally realizes the trap he's stuck in. He decides it's time to change, and he implements a really effective, actionable 3-step plan. Step 1, he sits down and creates a budget so he can see exactly where his money is actually going. Step 2, he completely stops using his credit card for unnecessary purchases. Basically, he stops adding new snow to the snowball. And step 3, he starts making extra payments, specifically targeting his highest interest debt first whenever he possibly can. Little by little, those leaks in the bucket get plugged up, and his loan balances start shrinking significantly faster. He discovers firsthand that while interest can definitely work against you, discipline works even harder.
Section 6. 10 years later.
The reversal.
Let's fast forward a bit to see the dramatic payoff of all that discipline. Look at past Alex. He was the guy always paying interest for things he wanted today, constantly losing time, constantly losing money. But then look at future Alex. He has completely paid off all that expensive consumer debt, and now, instead of paying interest to a bank every month, he takes that money and invests it regularly. He is now the one earning interest. Like Maya tells him, you switch sides. The exact same financial principle of compounding interest that used to trap him and hold him back is now actively working in his favor to build his wealth. Talk about a game changer.
So, to wrap this all up, let's look at the core takeaways from everything we've explored. Loans themselves aren't the bad guys. It's all about borrowing responsibly. You always need to understand the actual interest rate. Read the loan terms so you know the full total cost, not just that tempting monthly payment. Borrow only what you can realistically afford to pay back. And ultimately, the goal is to owe less, save more, and position yourself so that interest is working for you rather than against you. Real financial freedom doesn't come from having a limitless credit card. It comes from having your money do the heavy lifting on your behalf. I want to leave you with this final, somewhat provocative thought. Every loan tells a story about money today, but what choice will you make for tomorrow? Think about the leaking buckets or those uphill snowballs in your own financial life right now. Are you buying time or are you paying for it? I really hope this explainer has shed some light on the hidden mechanics of borrowing. If this resonated with you, definitely share these lessons with someone who might be thinking about taking out a loan right now. Because honestly, understanding interest today can save literally years of stress tomorrow. Thanks so much for learning with me, and I'll see you in the next explainer.